Hey, so I know you've been hearing a lot about the 3% down payment opportunity for first-time homebuyers, and I'm sure you're kind of confused. Is this the right product for me? Should I wait? Should I save more, for a 20% down payment, all that stuff? And so I'm going to share with you 3 pros and 3 cons of the 3% down payment opportunity for first-time homebuyers. And, I think it's going to be helpful because I want to help you and prepare you to become a smarter shopper and a smarter buyer because, for the longest time, it's been beaten to, even in my head before I became a mortgage broker, that you have to save 20% down payment. You have to save 20% down payment to purchase a property or you're not going to be able to buy a home, which that in itself is a complete false myth, rumor, whatever. And I hope you understand that. But the second one is, if you don't, save 20% down, it's really a bad mortgage product, which I have to disagree because it really depends on the situation for the home buyer and what their strategy and motivation is, right? And so with that, I'm going to provide 3 pros and then 3 cons right after in terms of for the 3% down payment conventional loan for a first-time home buyer. So the very first one is going to be that you're going to have lower upfront costs. And when I say upfront cost, I don't mean that a down payment is a cost because technically it's not. It's actually just cash out of pocket to kickstart your equity for your home, meaning that, equity is how much net worth you have built up into that property, right? And so if you have a $100,000 home and you put 3% down payment, that means that your loan is 97% or $97,000 and your 3%, your equity is going to be $3,000 for that property. And so you are kickstarting your equity with $3,000 that's already built in, right? That pad that you created kickstarted with the down payment. So it's not necessarily a cost, but in terms of cash to close, cash out of pocket at the end of the day, it's going to be reduced, obviously, because your down payment is lower. That means your cash out of pocket, total cash out of pocket is going to be less than somebody that's putting 5%, 10%, or 20% down payment. So that's pro number 1. Pro number 2 is that you're going to accelerate your home ownership opportunity, right? Because of the fact that you don't have to save as much for first-time home buyers. You don't have to save 20%, 10%, 15, 5%. You only have to save 3% down payment. So that means you're going to be able to get into that home a lot quicker. And that's going to be huge for some folks that are tired of renting and they're paying that rent. It's not going to building up their net worth or going into building up their equity and bringing that loan balance down. It's really, paying somebody else. I know there's pros to renting as well. I was a renter for a very long time, but in terms of creating net worth, it's definitely a con to rent. And there's a big pro to home ownership for creating net worth. And so accelerating that process to build your net worth by purchasing a home, 3% down payment. I mean, there's no other better option for you unless you are a veteran, which if you are, you should be considering a VA loan with a 0% down, which is only for VAs, right? So you should be considering that. But for everybody else, it's either going to be a 3% down payment for a conventional loan for first-time home buyers. And depending on your situation, you might qualify, you might not. But that's for another day and a separate conversation or a specific one with your mortgage broker, okay? And so number 3 is going to be that you're going to have more cash for other expenses, right? So, to buy a house is going to be your down payment and closing costs, which we call cash to close in the mortgage industry, right? Cash to close, your down payment and your closing costs. But outside of that, after you buy a home, you have to consider moving expenses, right? Either renting a U-Haul or moving cross country. I had to move cross country from California to Maryland. And so, hiring a moving company and paying for that was thousands of dollars to move across country. And then separately, you're going to have to think of, do you want to furnish your new home? Maybe your old furniture doesn't fit your new home, or you bought too big of a home and you got to buy more furniture, bless you if you did that. And then the other thing is, unexpected costs, like you have to do certain repairs when you are a homeowner, right? So for myself, within the first year, because I bought a home that was a little bit older, I had to replace one of the AC units and then I had to replace one of our boilers. And so those are the things that unexpected costs that I wasn't aware of as a homeowner or wasn't expecting that had to come out of my pocket because I didn't want to use credit cards and all that stuff. And so, those are things that you're going to have more cash in hand for other expenses. And then on top of that, if you just don't want to spend that much money on a down payment, then you get to have, cash for vacation or other things that you want to spend for. But number 3, major pro is that you get to have cash for other things that you want to spend on. All right. So those are the 3 pros for a 3% down payment for a first-time home buyer for a conventional loan. Okay. Not an FHA loan. This is for a conventional loan. And now 3 cons for a conventional loan, 3% down payment. All right. So the very first one, if you didn't realize, is that you're going to have a higher mortgage payment, right? Because of the fact that your loan amount is most likely going to be higher than if you had a bigger down payment. So meaning, right, if you were buying, again, the $100,000 home scenario, your mortgage payment on a $97,000 loan over 30 years is going to be higher than a $90,000 loan or a $80,000 loan. And so that's something to consider. And typically the mortgage payment, okay, is going to be principal and interest. That's the mortgage payment. I know you hear probably PITI, mortgage, interest, tax, and insurance, but the tax and insurance is not a mortgage payment. That's part of the housing expense that you're paying if you are escrowing, but the mortgage payment is made up of principal and interest. And so just keep that in mind, that the principal interest payment for your mortgage is going to be higher if your down payment is less. All right. And then number 2 is going to be private mortgage insurance. Private mortgage insurance, or also known as PMI, is something that the mortgage companies add on, right? The lending institutions, not the broker or whoever, but the lending institution adds on as kind of an insurance because they consider somebody with a lower down payment to be a little bit more risky and to lend money to. Not that it's super risky, but a little bit more risky. Why do they think that way? Well, it's because if you think about it from a company's perspective that's lending money out, 20% down is the typical kind of, bread and butter, typical down payment that they prefer without getting a PMI or private mortgage insurance. But anything less than 20%, it's considered a little bit risky. And so what they're going to do is they're going to add on this insurance amount that you're going to have to pay in addition to your principal and interest, and in addition to your mortgage payment. And that, the principal, what does it do? It goes to paying down your loan balance. Interest, it pays for to the lender because they're making money through the interest. And then the private mortgage insurance also goes straight to the lender to pay as an insurance policy in case they think that you're going to default or something because of the fact that you don't have enough money to save up for a down payment to buy a home. Okay, and so that's why there's going to be a PMI to it. It's nothing that's out of the ordinary or anything else. It's just think of it as an additional fee that you're paying monthly. Now, for a conventional loan, I do want to remind you, though, that once you get below 80% of the value, so how do I explain this? So once the loan balance drops 80% or less, then the value of your home when you purchased it, okay, then the private mortgage insurance is going to drop off. Meaning, if your purchase price is $100,000, right, for your home, and then your initial starting balance for 3% down means your loan balance was $97,000, right? That means the moment that loan balance gets to $80,000 or less, then you qualify for that PMI to be removed. It automatically gets removed when it's at $78,000 or less, or 78%. But at 80%, you qualify for that to be removed by just making a call to your mortgage servicer and requesting for that PMI to be removed. Okay. If you don't, then you're going to have to wait until that automatically it removes that 78%. So I recommend just track it and then remove it. Or another way is to refinance out of it. If the equity of your home or the value of your home increased, right? And then you just refi that same balance amount and with the equity and stuff. So that's again, I digress. Completely separate topic. I'm probably confusing you, so I'll create a separate video for that. So the number 3 con that I realized that a lot of folks in the lending industry, as well as home buyers, definitely, that I've noticed. It seems to be usually things that they've never heard of, as well as the realtors that, I talk to realtors and they're kind of unaware of this opportunity, is waiving escrow. So typically for home buyers that come to me, I recommend them, if they feel like they're able to manage their finances well, to waive escrow. And what is an escrow account? Well, an escrow account is, just think of it as a savings account that's specifically for your property tax and home insurance. Okay, so every mortgage, every home that you buy, you need to have property tax that you got to pay, right, in the United States, and there's home insurance to insure your property for anything that happens, right? And so typically you create an escrow account and you contribute to it on a monthly basis with your mortgage payment, and annually that escrow account pays for your property taxes and pays to renew your home insurance. Now, why do I recommend most home buyers, if they can, and they feel like they're able to manage their finances well, to waive it? It's because to kickstart that escrow account costs usually hundreds and thousands of dollars to kickstart, because it requires about 3 to 6 months of escrow, of that monthly payment of the escrow, to kickstart that account. And so it's going to be thousands of dollars typically, especially in the DMV. It's going to be in Maryland, DC, and Virginia, if you don't know what DMV is, in the DMV area. And so I recommend them to waive it. But for a 3% down payment conventional loan, right now, as of this video, the home buyers don't qualify to waive the escrow account. Why is that? Well, it's because, again, the 3% down payment is seen as a little bit risky for the mortgage lender when they're reviewing the risk assessment. And so because of that, they're going to say, no, because you didn't show that you can save enough money, we're going to require you to at least create an escrow account, so that the escrow account, as you contribute to it, it's going to pay automatically for your property tax and home insurance. Okay. And so that's one of the cons, because again, when you go to cash to close, you want a little bit more money in your pocket. And so you don't want to create and, contribute to the escrow account and stuff like that. But for a 3% down payment conventional loan for a first-time home buyer, you don't qualify for it. Okay. So with that, those are the 3 pros, 3 cons. Hope this was helpful. There's a link in the description for a free home buyer's guide if you're interested. All it requires is a name and email address. And so with that, hope this was helpful to you. Have a blessed day.